Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Dan Lewkowicz. He is a seasoned real estate investor with 15 years experience in many facets of real estate, in many facets of the real estate industry, starting his career as house hacking. He quickly moved on to flipping houses around the Detroit area and eventually created a company called Renaissance Real Estate Ventures, which specializes in the acquisition, financing, renovation, and resale of single-family residential properties in the booming city of Detroit, Michigan. Currently, Dan is a senior director of Encore Real Estate Investment Services and specializes in shopping centers, medical office buildings, pharmacies, quick service restaurants, discount retail stores, and automotive repair and parts stores, as well as resorts. Dan, welcome to The Wealth Flow. Looking forward to chatting with you here today.
Yeah, thank you so much. Thanks for having me on. I'm looking forward as well.
I like to typically start with your background, where you grew up and what eventually led you to real estate.
Yeah, so my background, I grew up, born and raised in Metro Detroit. I did live overseas for 4 years in Israel, which was a pretty incredible experience. This was back in 2007 till 2011. Went to Oakland University, got a degree in psychology, which I do believe I use every day, but obviously it's not my, technically in my profession, although very valuable. I got my start in real estate back in 2005. I was working with some friends. They had started a barrier-free home modification company that is called Disability Made Easy. Company's still in existence, still around. That company was designed to provide home modification and renovation services for people that were handicapped, had terminal illness or injury. I did all the sales and marketing. That was really my background. But I got a chance to spend some time with our project manager who was out there in the field, looking at properties, renovating properties. And I'll never forget, I had a big aha moment. We were driving to a specific client. We got to the property and the individual was in a wheelchair. He had been paralyzed, unfortunately, from an auto accident. And went out of the property. I said to the project manager, I was like, let's get in the truck. Let's get out of here. Like, what are we going to do? We can't do anything with this property for this guy. He didn't say anything. He took out a pen and some graph paper, started sketching. And in 90 seconds or so, he sketched a brand new front elevation and redid the layout of the property, making it suitable to its occupant. And to me, what I recognized is that you could take something that was maybe functionally obsolete, maybe distressed, maybe outdated, make some changes, and then all of a sudden what you've created is more valuable than what you've put in. So that really started for me a kind of a chain reaction, buying my first home, going through a similar process, buying a bank-owned distressed property rather than a ready-to-go property during the last recession, renovating it, adding value. Now, again, the sum of the parts is greater than what I put into it. And that kind of, spurred me on to flipping house after house after house, and really seeing the value in that. For a long time, I was doing that on the side while, working in corporate America at Amazon as a business development executive. But inevitably, I went full-time into house flipping and then transitioned from that into commercial real estate brokerage, which is where I've been full-time, ever since. I still do, scratch that itch of flipping houses from time to time, but really my day and night is commercial real estate brokerage.
Okay. And are you doing that all in the Detroit area, or where are you focused?
Yeah, good question. So actually nationwide. So, right now I've got property listed in probably a dozen states. I probably do 30 to 40% of my business here within the state of Michigan and the remainder, in various states all across the country. So that's the great thing about what we do is, it's less so much about where the property is as opposed to the underlying fundamentals of the real estate, the demographics, the traffic counts, the guarantor strength on the lease term, the rent to sales ratios, all those things are more important than, which state per se that the asset is located in. Yeah,
for sure. Well, tell me a little bit about Detroit, though, since you did a lot of the flipping and everything in there. It's always been kind of an interesting area. I just, hearing, prices that you can get homes for, and I'm sure it's not across the city. Obviously, every city's different, right? And there's pockets where there seems to be some great values. But tell us a little bit about what your thoughts are with, after working in that area and living in near that area for quite some time.
Yeah, great topic to talk about. And, the caveat is that, I flipped my last home in the city of Detroit proper in 2019. So anything I'm going to talk about will be dated. I mean, I've kept up with some of the trends, but any of my house flipping investments have been outside of the city of Detroit since then. I mean, what I'll tell you is that, some of the wildest experiences of my life occurred in the city of Detroit as a house flipper. I could talk to you for days about the crazy things that I saw and experienced there, for better or for worse. What I will tell you is that what I noticed back in 2015 was that the city of Detroit was about 7 years behind the rest of the country in the foreclosure crisis. So in 16, 17, 18, 19, the banks were still trickling out homes for sale in Detroit that they had stopped selling in the suburbs years before. So for me, when I was flipping in the suburbs at first, when I saw prices starting to rise and inventory really starting to dry up, that's when I moved into Detroit because there was opportunity there because of that delay. So yeah, I mean, I can list, addresses of properties that I bought for $5,000. Can list addresses of properties I bought for $1,000 or $2,000. I can also tell you that without boots on the ground and an exquisite knowledge of the city of Detroit, you're very likely to get burned. Detroit is not just a neighborhood by neighborhood, demographic. It's a block by block or house by house situation. You could have one block that looks incredible, right? You drive down it, manicured lawns, houses are maintained. Go one block over and you've got bombed out houses, burned out houses, and boarded up houses, right? So you really have to know what you're doing. I saw a lot of people. I mean, a lot of my clients, I would buy a property for 5, 6, 7, 10,000, whatever it is, renovate it, and then sell it to a group that would put a tenant in it, put some property management in it, and then they would sell it for double what I sold it to them for, right? So, you got to be careful. There are a lot of groups, unfortunately, that are, doing things that are leaving the investor holding the bag. So like anything, it's just important to have in your toolbox, good people that you trust that know what they're doing.
Okay. One other question with respect to that: how is it working with the government there? City officials and every city seems to be different. Some are super pro, coming in and doing renovations and seem to help pave the way. Others, it seems like despite the fact that there's a critical need for that, there sometimes is roadblocks that seem to be unnecessary roadblocks, lots of bureaucracy. What is it? What's the environment like from that standpoint?
So like anywhere, it's municipality by municipality. I mean, and that goes for within the, there's the city of Detroit, but then in the suburbs as well. I mean, I bought houses at tax auction for a few $1,000s where, not in the city of Detroit, where if I didn't cut my grass, I'd get a $250 fine the first time. The second time, $500. The third time and thereafter, $1,000. So exorbitant fees like that make it difficult. I mean, granted, on the other side, it's a motivator to keep the property up to a certain standard, right? So I get it, right? The city of Detroit itself, I mean, there are a lot of, the municipality can be challenging to deal with. I also dealt with, hearings where I had a property where the grass was more than 6 or 8 inches long, which happens sometimes, right? And then I got, a letter in the mail saying that there would be a hearing and that the house was going to be demolished and that I would have to pay the $35,000 to demolish it, right? Certain things like that make it hard to deal with. The bureaucracy is hard to deal with. However, there's opportunity as well. I mean, I bought a lot of properties from the Detroit Land Bank. which was difficult to deal with, but also, provided opportunity. So, I would just say, like, again, go in with your eyes wide open. It's not always easy. You need someone who can help you navigate it because, these municipalities can be very difficult to deal with, especially when they're understaffed or underfunded or just under-equipped to deal with the situations that they have in front of them, which is often the case.
Okay. And then, let's dive into commercial real estate brokerage and kind of tell us a little bit about your focuses there. Obviously, it looks like quite a few different things. Whether it be shopping centers, medical offices. Tell us a little bit about the different types of commercial real estate and the opportunities that you see with those.
Sure. So everything that I do, or I should say 95% of what I do, falls into those two main buckets of shopping centers and single tenant net lease properties. Within single tenant net lease properties, which I can talk about a little bit more what that means if you'd like.
That'd be great.
There's all different types, right? So you've got, it doesn't really matter what they're doing or what they're selling, right? If it's a dollar store, if it's a dialysis center, if it's a medical office building, if it's some other type of discount retailer, if they're selling fast food or selling prescriptions, right? Those are all going to be, in general, those are net lease, single tenant net lease properties. So let me just take a step back and, discuss what that is. So a single tenant net lease property just means single tenant, right? So it's one tenant in one building. So you can think 4 walls, and some partitions, obviously, and one tenant. And they're on what's called a net lease. And the reason they're on a net lease, that's called a net lease, is because the rent that you collect is net to the investor. So the first type of net lease we can discuss is what's called an absolute triple net lease, okay? That's like the bread and butter, cookie cutter, what we're looking at type of net lease. So in that case, the taxes and insurance are actually paid by the tenant. The common area maintenance is paid by the tenant. Any management, any type of maintenance or renovation paid by the tenant. So you as the landlord, if the tenant is paying you $150,000 of annual rent, that's net to you. You don't spend a dime on anything. If there's snow that needs to be plowed, they plow it. If there's grass that needs to be cut, they cut it. That's an absolute triple net lease. No landlord responsibilities whatsoever. The kind of step down from that would be what's called a double net lease. Double net lease is exactly the same. Tenant pays for the taxes and insurance, any common area maintenance, management. What they don't pay for is roof and structure. And in some cases, they don't pay for parking lot, or parking lot and sidewalks, depending on what the lease says. So obviously not as desirable. A lot of dollar stores are on double net leases. Some pharmacies are on double net leases. But, in general, that's what a single tenant net lease property is. A shopping center, I think everybody knows what that is. Multiple tenants. Those can be on gross leases or triple net leases. The gross lease would mean the tenant pays, let's say, $12 a foot to the landlord. That's gross. The landlord then pays for everything else. They pay for the management. They pay for lighting the parking lot. They pay for shoveling the snow and cutting the grass and doing any type of maintenance, right? Now, in a lot of cases, and I advise all my clients who have shopping centers to convert their leases into triple net leases, you can have your base rent of $12 a foot, right? However, the tenant also pays triple net charges, or what people will call CAM charges, common area maintenance charges. So that could be $3, $4, $5 a foot, with the idea that the landlord can reconcile that at the end of the year and change those numbers if he or she has to. But the point is that, number one, the expenses are fixed because they're passed on to the tenant. And number two, it's more desirable. So it actually can positively impact your cap rate and therefore your value of your center. So, those are the two main types of assets that I deal with. If I have a client that has some resorts, I sell them for him or her. But generally speaking, I work within, that world of the net lease space.
Okay. And typically on those, are you selling properties once, say a pharmacy, let's call it a Walgreens or a CVS or whatever, has leased the space itself, and then you're selling it to an investor after the fact? Or tell us a little bit about kind of what those deals typically look like.
Sure. Yes. So the majority of the cases, we're selling cash flowing assets with leases in place. Now, I do also work with a lot of developer clients. Like right now, I'm working with a developer client who's building a bunch of Starbucks. And the way that process works, developer buys the land. They probably typically don't even wait. They wait to close on the land until they have a signed lease with Starbucks, right? They close on the land. They start building. They build the shell. They have a certain agreement with Starbucks. Once we're, let's say, 90, 120 days out from the rent commencing, I'll list the property for sale. New owner will come in, buy the property with a cash flowing, Starbucks lease in place. Now, obviously, I also deal, especially today more so than ever, with a lot of vacant properties. So let's say you're Rite Aid that went through bankruptcy and then vacated the property. Now I'm selling that property, either to somebody who has a tenant that they want to work with already, or someone who's going to redevelop it. Maybe they'll convert it into some other type of, 2 or 3 tenant structure if they can figure that out, and then resell it or hold it. But in general, most of the properties that we sell, they're being bought for cash flow, and there is an in-place lease with a tenant.
Okay. And so that example that you gave with, say, Rite Aid or any of them, you'll occasionally see these, single tenant properties, and you don't just see it in single tenant, but you see it in single tenant sometimes where it's clearly it was or may have been a pharmacy of some type. It's not anymore. So somebody that's buying that, what are some things that they should be looking for within the lease to help protect them? And I guess what are some of the things that we should be looking at when it comes to the lease to protect ourselves as an investor if we're going to be buying something like that? Do they have wiggle room to be able to get out? Just down the street from us, there's, for instance, a Chick-fil-A. I don't know if they've got those up there, but So Chick-fil-A, right? But they built a new location, probably somewhere in their lease. There was an ability to be able to get out and move to the new location, or maybe there was some wording that allowed them to. Maybe they're still paying on both of them. I have no idea, but I know that there's now a building that was occupied, is not currently, and obviously, if I was the investor holding that, I'd be concerned. So anything to any words of wisdom that you can provide us of things to be able to look for as far as outs within the lease or that kind of thing?
Yeah, absolutely. And I mean, I can't drive too far down the street without, talking out loud to myself, like, oh, look, that's a Family Dollar and a former Rite Aid, or like,
Right.
Look at this, that Planet Fitness used to be, whatever it used to be. I guess because I'm kind of maybe, for better or worse, obsessed with this stuff. But yeah,
Right.
the answer to your question is absolutely. There's a lot of things you can look for. So first of all, a Walgreens is not this Walgreens is not that Walgreens is not that Walgreens, and the same thing for every other property with most properties. A Taco Bell is not a Taco Bell is not a Taco Bell. They can be very different. And the reason I'm kind of saying that is like there are Walgreens that have a corporate guarantee that are guaranteed by the whole corporations. There are Walgreens that are guaranteed by a subcluster of 7 different sites, right? So first and foremost, you always want to examine your guarantor strength, right? You want to know, is it a corporate guarantee? Is it a franchisee guarantee? How large is that guarantee? Is this franchise, by the way, maybe this franchise operates 100 locations and you feel great about it, but maybe the guarantor on the lease is 123 Main Street, Burgers LLC, and they only operate this one location because they know that if they're having a problem, all they need to do is bankrupt that one entity, right? And they don't have to pay you anymore. So that is super important. Guarantor size and strength. Make sure you know. I can't tell you how many clients I've talked to or I've worked with that got into problems because they didn't know that, okay? The next thing to consider, this is a little nuance. We call this a wrinkle in the lease, right? Something that people often maybe looked over because the lease was wrinkled. That's the metaphor. But, one of my first deals was like this. There was a co-tenancy clause, right? It was a PetSmart deal that had a co-tenancy clause that if I believe it was a Lowe's or a Walmart, if they ever vacated, that was like next door, then immediately PetSmart would drop their rent by 50%. Imagine what that would do to your net operating income, right? It would cut in half. Imagine what that would do to your value of your property, right? So automatically, even though the co-tenancy clause was not enacted, right, they were still there, they're paying full rent, the property is worth less than a different PetSmart that's exactly the same right on the surface, but doesn't have the co-tenancy clause. So that's really, really important to note. Aside from that, kind of to the first part of your point, if there's a lease and the lessee is not going to get out of the lease because it's too strong of a guarantee, they will continue to pay when they go dark. And that's what often happens with these pharmacies. They oftentimes will work with the landlord and sublease to a tenant like a dollar store. Now, on the flip side, if you're the buyer coming in and buying that dollar store, don't be fooled by the cap rate, right? Because you might say, oh, this is a Walgreens sublease to a dollar store at a 9 cap. That's amazing. Yeah, because it is a 9 cap, but that's when you look at the current rent being paid by Walgreens. What you don't realize is that the dollar store is subleasing from Walgreens and they're only paying $150,000 a year, right? Not 300 or 320, whatever I just said. So when Walgreens leases out, even if the dollar store will continue renting from you, you're going to lose half your income and your cap rate's going to go way down, right? So that's something that's very important to look into when you're buying a sublease, okay? And then obviously you want to look at the lease term. You want to see, how long do they have left on the lease, right? Because if they have 1 or 2 years left, who knows if they're going to stay? Furthermore, if possible, you want to underwrite the fundamentals, the financial fundamentals of this location. So in many cases, the tenant is required to produce yearly or once requested, when requested, once yearly financial statements. So if I'm buying a Wendy's and I want to buy a Wendy's, number one, that produces sales reports, that will give the owner sales reports, but I also want to compare that, right? So like if I find a Wendy's and they're doing $1.1 million in sales, I'm saying, that's well below the national average. If I have a Wendy's at $2 million, that's well above the national average. That's important. And furthermore, and this doesn't just apply to fast food restaurants, it also applies to, for example, auto parts stores. You want to look at something very important called the rent to sales ratio. It's very simple. Take the rent that the tenant is paying, take a look at their sales, and see what that ratio is. For example, in the fast food world, the quick service restaurant world, typically we want to see a rent to sales ratio no higher than 8%, preferably 7.5% or 7%. And by the way, when the rent to sales ratio gets above 8%, like 9, 10%, if you get a double-digit rent-to-sales ratio in the fast food industry, there's a huge chance that store is going to close, and you don't want that. So sales reports and rent-to-sales ratios are also super important. And then I just say, underwrite the fundamentals of the real estate as well. Look at the real estate. Take the tenant out of the equation for an example. What are the traffic counts like? What's the visibility like? What's the ingress and egress like? I'm dealing with a property right now that's a bang-up property. They're actually doing really well there, but the ingress and egress is not good. I don't like that, right? So that's really important. Look at the proximity to other national retailers. Is Chick-fil-A there? Is Walmart there? Is McDonald's there? Is Walgreens there? If they think that's good real estate, you can bet on them, right? And then, I think that it's also definitely important to look at the average household income, depending on what products this tenant is selling, as well as the population density. You want to get a lot of people. You want 100,000 or more, usually within 5 miles. Those are all important factors to look at, Keith, when you're underwriting a property, the lease, the tenant, the financials, et cetera, to make sure that you don't get burned.
Yeah, I think we've all, just driving around, and maybe not, like you said, not everybody may pay attention to some of this stuff, but you mentioned the ingress and egress. And there are certain shopping centers that I've seen that just seem to, things can't make it there. I mean, you might have one tenant that's been there forever, never seems to leave, but it's a little difficult to get in. If you actually have to get into that shopping center to do something, it's like, oh crap, I'm going to have to go and do a U-turn here, get in here. And it becomes a bit of an issue while there are businesses and it may be, 90%, 95% occupied, they, it just seems like there are things that just a new thing comes in and then it goes out of business, and the new thing comes in and goes out of business. And so, what are some of the things that you try to look at when it comes to ingress, egress, and what are some tips with respect to kind of analyzing that?
Yeah, great question. So I look at it like I view people as lemmings, right? They're going to take the path of least resistance. And I know myself, I'm really stubborn. If I'm driving somewhere and I need gas, I'm only making a right turn because I don't want to make a left turn, go get my gas, make another left turn to get out of there. I want to keep going. That's just my mentality in life. I think a lot of people are like that. So, I dealt with a lot of properties where the city comes in, they divide the roadway. Now you can't make a left into the property. You have to go around and loop and then come back around. That's terrible. I mean, so many vacant properties that I've looked at, they were doing great. And then all of a sudden there was something like that changed. And, now you're in trouble, right? I have a Wendy's properties that I sold where the city, essentially they put in one of those like pedestrian stops in the center of the road so that people didn't have to walk all the way across the road, a little island, if you will, which is great idea. But they put it directly in front of the drive-through entrance to the Wendy's, right? So that made that Wendy's a lot less desirable. Ownership knew that, and it was sold at a cap rate reflective of that. So those are the types of things that I look at. I want to make sure it's easy to get in and easy to get out. And then another important thing, maybe equally as important, and we see this in some parts of the country more than others, is the visibility, right? Some states or some municipalities have made a big deal about taking that city setback and planting a ton of vegetation. right? Well, if that vegetation is blocking my Walgreens sign, I think that's going to affect sales. So that to me is equally as important, ingress, egress, as well as visibility, because those are the things that are going to, determine whether or not a person comes to your property or they go to the next one down the road because it's more convenient and more visible.
Yeah, that's a good point. And even trying to get new signage sometimes is just a huge hassle, right? If you're saying, well, the old signage might have been good for what was here before, but what we're looking for, we want much more visibility. Trying to upgrade that sometimes becomes a challenge as well. Just getting it passed, and not everything's necessarily grandfathered in, and so that can be an issue for sure. What about planning? Because sometimes even for some of this stuff, like you mentioned, putting the median in, or I know I had a piece of property one time that was kind of in line with future road development, and this stuff is laid out years and years in advance, and so we were able to pull it and say, okay, actually, this is going to be this is going to kind of work to our benefit, the future plan. So we were able to advertise that piece of the puzzle. But maybe talk a little bit about that and where you can look to see some of that stuff in advance.
It's just reminding me of a deal I was working on, like a 210. I think it was an O'Reilly Family Dollar. And that's what it was. The city had actually had a plan to relocate the freeway exits. And what they were going to do was they were going to actually move so they exit to this, is more of a center with this out parcel with the 2-tenant box there. So the current exit, you'd get off the exit and come right into the center. It was perfect. So they were going to eliminate that exit and move the exit past this shopping center, which would have been detrimental to this property. And the owner was livid. I mean, he just bought it and then he found out about this and it just was a mess. So, I guess I would say had he done some, no one would think to do this, right? You wouldn't think to go to the planning commission or go to the highway commission and say, hey, do you guys have any plans in the next 20 years, right? But had he done that, he probably wouldn't have bought the property and he wouldn't be in this predicament. So that's one thing you can do is talk to the municipality. And I know when I sell a lot of development deals, I always talk to the municipality and I say this is a little bit off topic, but I say to them, I said, what do you guys want to see here? What don't you want to see here? What aren't you going to allow here? And as a broker, it's super helpful. I mean, I have a deal recently that died. Former CVS, big oil company was under contract and they wanted to convert it to a gas station. I let them handle everything. They said it was going to be easy. And then 2-3 months later, they reached out and said, you know what? Municipality said there's no way. It would take us years to, with a zoning attorney to even get their ear. So maybe I should have reached out and found out myself. But I guess the point is that type of diligence is pretty easy. It could be a couple phone calls and it could get you a lot of information that's super valuable as to whether or not you should invest in a specific property.
Okay. Well, and I like some of the things you've talked about as far as the rent to sales ratio and what it is for fast food. What about traffic counts? What are those typically? And it may vary, and you can let me know. Depending on where it is, maybe it varies depending on the city, that kind of thing. But what are we looking for as far as traffic counts that are good for those major, franchise type?
Yeah, so that answer would be definitely specific to the type of actual asset. So dollar stores are typically in more tertiary areas, the majority of them at least. So I'm not going to get the same types of traffic counts that I'm going to get for a pharmacy or a fast food restaurant. But if you're in a more, dense area and you're looking at a fast food restaurant, 15 to 20,000 is decent. Anything above 20,000 is pretty impressive. Hard corner locations. And when I say hard corner, that's one road on another road. Think about your typical Walgreens or CVS. A lot of them are main on main, hard corner lighted intersections. Those could see 30, 40,000 or more vehicles per day. I've sold shopping centers that were on corners that had 50 or 60,000 vehicles per day. So it's the more the merrier. As long as the ingress, egress, and visibility is good, the more the merrier on traffic counts. I just can't stress enough. I've got a deal right now that great visibility. Oh man, if you look at aerials of this property and see all the different cars going by, the visibility is incredible. But there's no access from the main road. You have to go off the main road, make a right, then turn down, then make another right again. And that's killing the property. It's killing the desirability of the property. So traffic counts are great, right? I love that there's 30,000 vehicles per day on that road. I don't love that there's no way to get into the property from that road. So, you can't take one without the other. They're both very important. What else can I say about that? Again, I'm thinking about all the properties I've looked at that have great traffic counts, but because of a median that the city put in, you can't turn left. That traffic isn't as valuable to you. So, you can't take either of those in a vacuum. You have to consider traffic counts as well as ingress, egress, visibility, all together when you're analyzing the deal.
Okay. And what about some due diligence, on whether it be existing shopping centers, whether it be, the single tenant stuff? What are some of the biggest things that seem to come up in the due diligence process that, maybe deal killers, or maybe, wow, this was a great find here that we were able to uncover this, and maybe it's not obvious to other people looking as well, that would make it just an incredible deal.
Yeah, so I'm a deal maker and I'm a fan of transparency. So unless instructed otherwise by the client, I like to provide as much information as I can up front. Some brokers will hold things back until later. I don't like that. So things like the lease, prior environmental report, any previous property condition assessments, a list of capital expenditures at the property, previous environmental reports, title reports, all that you'll get up front. That you'll get as soon as we start our deal, right? You might even get that before we sign a contract. It just depends on the situation. Once we have a contract signed and that due diligence starts, that's when you as a buyer, whether I'm representing you or you've got your own broker, that's when you're going to have to, want to start looking into things like updating the third-party reports, right? So property condition assessment, essential, not expensive, will give you a ton of information. And by the way, as a listing broker, or maybe I shouldn't say this, but by the way, it's going to give you a tool to negotiate if you have to, right? I can't tell you how many deals I've seen where the PCA, property condition assessment, comes back and the buyer is like, hey, look, here's $300,000 in repairs that are needed now. Let's lower the price by X, right? So that's important. It's a very, very good bang for your buck. Then you're going to want to do a phase one environmental, especially if you have a lender, they'll probably require it. Not everyone does them, but you just never know today. And especially in states like Michigan has an incredible program. They've got something called a BEA, a baseline environmental assessment. So Michigan's very friendly to commercial property owners insofar as if you have a property that has some form of contamination, as long as you, the new owner, do a phase one environmental and do this baseline environmental assessment and a due care plan if necessary, which just says what you'll do in the future with the property if there's any issues, the state of Michigan will actually take on all liability for any future release from that contamination, which is incredible. I know why they do it. They want to keep the property in usage. They want to keep the tax base up. But it's really great for investors. If you don't do that phase one during due diligence, you lose out on that protection, right? So that's super important. That property condition assessment, I said, that's also very important. Going and visiting the property, if it's a multi-tenant, I think it's essential. Single tenant net lease deal, do you have to go visit it? I don't know, maybe not. What I will tell my clients, I can't tell you how many clients I have that have owned triple net properties in other states and they went 15, 20 years or more without ever seeing them. And then it comes time to sell them. And guess what? Even though they were triple net properties, the tenant wasn't keeping up with their responsibilities. So I tell my clients a little, pro tip, every 2, 3, 4, 5 years, spend the $750 or so, even though it's an absolute triple net property, get somebody up there to do a property condition assessment. Because if you find out that there's a problem with the roof, guess what? Now you can send the report and pictures and a short letter telling the tenant that they will be in default if they don't fix this. Rather do that than when it's time to sell and the tenant is leaving and now, you've got all this disrepair and deferred maintenance and now it's going to fall on you. So that's super important. And then, like we talked about, things people don't think about is talking to the municipalities, seeing if they have any plans to put any things that are going to restrict the egress or ingress or move exits or things like that. That's all really important. And then obviously you're going to want a broker and or attorney to review the lease and then an attorney to review all the documents. I highly recommend it. I deal with a lot of deals where buyers and sellers don't use attorneys and 99% of the time it's a mistake. So invest the few $1,000s or a little more that it's going to take in protecting yourself just to make sure it's bulletproof. You don't want headaches after you buy what's supposed to be a headache-free asset.
Yeah, for sure. And so what are some of the deals that you're seeing out there right now when it comes to commercial real estate as far as maybe better cap rates on these types of assets? Any specific type of franchise that you feel like is an opportunity that maybe others may miss?
Yeah, so we're in an interesting swing, right? Because the last 24, 28 months or so, well, really not the last, but this period of time, we saw interest rates rise at historic rates very rapidly. And, obviously rates were held steady for quite some time, about a year. And then we just saw a 50 basis point reduction in the federal funds rate, which, by the way, didn't really trickle down to the mortgage rates. And we can discuss why. But anyway, we saw that. It's looking like we're going to see continued decrease in interest rates. So we've seen tremendous cap rate expansion over the last few years, meaning cap rates have gone up, prices have gone down. Now, I think cap rates are going to start going down, prices are going to go up. So now is a great time to buy. I mean, I'm looking at Starbucks deals that were trading at a 5.15 cap only 2 years ago, trading at a 6.75 cap today. So maybe there's some great opportunity to buy a corporate guaranteed lease, for a high cap rate. In general, I think a specific space that has a lot of opportunity is the shopping center space. Traditionally, shopping centers trade at a higher cap rate than single tenant net lease deals do. And what's nice about that is a lot of the single tenant net lease deals, they don't pencil out with traditional, financing today. But because the shopping centers have a higher cap rate, you get that delta, you get that spread between borrowing costs and cap rate that make the deal workable. So, I think shopping centers are a great space to look at. Additionally, they've got an opportunity for a tremendous value add component, either through, increasing occupancy, lowering costs, converting leases from gross leases to triple net leases, putting in better tenants, raising tenants to market rents as they roll over, et cetera, et cetera. A lot of opportunity there.
And how about with respect to financing on, say, shopping centers? What kind of debt are people able to get on those? What are you typically seeing when you're putting these deals together?
It varies. I think in general today, and this could change tomorrow, so don't quote me, but most of our deals that are getting financing, as long as they're a clean deal and a qualified borrower, we're looking at somewhere between 5.75 and 6.25%. Okay. I do have a lender I work closely with that has a program specifically for doctors. I'd have to pull up those rates. I probably could, but those rates are significantly better. Which is awesome. This doctor program that a lot of people have. So I think that in general, if you're not a doctor, you're probably looking at somewhere between 5.75 and 6.25. If you've got good credit and it's a good deal. I'm looking right here. I just pulled it up. So this was as of August 26th. So it's month 6 weeks old, 5 weeks old. So this one right now, a few deals got done at a 73% loan to value, 5% interest rate, 25-year amortization. That's on a Walgreens. That's much better than a regular person would qualify for. There was an urgent care in Houston, Texas that he did, 55% loan to value, so low leverage, 4.5% interest rate, 25-year amortization. So there's programs out there. Link up with me. I'm happy to make a referral and help out in any way I can.
Okay. No, that's perfect. And then what are some things maybe leading up to, you mentioned the property condition assessment. What are some of the expenses up front that somebody should anticipate, when they're buying a commercial property?
Okay. So, legal, it all varies. I've got an attorney I work with very closely. He charges $4,000. It's either $4,000 or $5,000. Half up front, half at closing, and he does everything, drafts all the documents, deals with everything, reviews everything. He's great. Most attorneys charge a little more than that, but I would, say $5,000 to $10,000 typically for a simple deal for legal. Environmentals, if you need only a phase one, and again, it's negotiable. Like you could, in your letter of intent and purchase and sale agreement, you could say that you want the landlord to pay for the owner, to pay for the phase one, right? Yeah. Everything's up to negotiation. A survey, like not everyone gets a survey. Sometimes there's a survey on record. Sometimes you need a survey if there's a lender involved. Surveys could cost $2,000, $2,200. Property condition assessment, maybe $750, $1,000. The environmentals for a phase one, depending on where it is, you're thinking like $2,000 to $3,000 roughly. If there's a phase two involved, then it's anybody's guess. But those are generally going to be your costs during due diligence, and then your costs obviously. When you're actually closing on the deal are going to be any lender-related costs. You're typically, as a buyer, not going to have any brokerage fees, but you're going to have to pay for things depending on the custom of wherever you are. You could be paying for some of the closing costs. You could maybe be paying for some of the title insurance or transfer taxes. Typically not, depending on the state that you're in. But you're going to have to maybe sit down with someone like me. I could tell you exactly what it is, depending on where the property is and what the price point is.
Yeah, makes sense. What about just geographically across the U.S. and the areas that you've been selling? Is there any particular area that you're seeing, just tremendous value, or maybe that just if somebody's listening that's considering selling something, that's really hot right now? Just any tips like that? Just what you're seeing across the landscape here.
Yeah, I mean, Texas and Florida are really hot. They tend to trade, lower cap rates. I think Texas is very, very, is a very strong market. Florida, there are some investors and some, huge, real estate investment trusts that are pulling out of Florida because of issues of inclement weather, and they don't have to deal with that, and insurance issues. But, really, I don't look state by state. I'm looking at the asset. I might fall in love with a specific Walgreens in Iowa, or I might fall in love with a specific Wendy's, in Michigan. But it's not really, for me at least, about the state. It's really about the actual asset, the fundamentals of the asset. Now, I will say there are certain tax-free states that provide, no state income tax that can be beneficial to people. So that is a consideration that people have as well.
Yeah. And then there's obviously other states, right, where just like property taxes, like Texas, which is where I'm located, where, I look at some other properties that we have in other states, and it's like, wow, I can't believe we're paying this much in property tax, compared to others. So it's just one of those components. But when you're looking at the deal itself, it's just one piece of the puzzle, and it's just part of, looking to see if the deal makes sense.
Yep.
So what are some things, Dan, maybe that we haven't covered when it comes to commercial real estate that you think it's important for the audience to know?
I mean, listen, first of all, reach out to somebody like me. I'm happy to provide my contact information, happy to provide any value I can. It's so important, like anything, practice makes perfect. And, you want to underwrite as many properties as you can. If you're going to buy a Walgreens, don't look at one Walgreens, don't look at 10 Walgreens, look at 100 Walgreens. I mean, I think about when I'm buying a house, for myself even to live in, the first house I see, I love it and I want to buy it. But then I go to another house and I say, oh, that house has a finished basement. I love that. Oh, this house has an attached garage. I love that. The more you underwrite, the more you understand, and the more you know what to look for, and the red flags that are out there. The other thing I'll say is, as I mentioned a minute ago, reach out to someone like me. I'm happy to provide value, talk you through any deal that you're working on, just in general, bounce ideas off each other. Even if we're not working together, I'd love to add value. So reach out to someone like me who can, be a resource and help you through the process.
All right. And as far as capital markets and everything seems to, there seems to be plenty of opportunity to get a loan on different things, or have you seen any pulling back?
I mean, the banks are well capitalized. Things have changed a little bit. I've seen lower, lower loan to values. We used to see 25% down. Now we're seeing 30, 35% down. Lenders are getting creative, deals that before they would have a 25-year amortization, but now they're not penciling with a 25-year amortization. The bank is offering a 30-year amortization to lower your payment and make the deal work. So a lot of creativity. I think lenders are hungry. I don't see, capital constraints or things like that to be concerned about.
Okay, perfect. Well, Dan, maybe if you could tell the audience where they could find out more about you and connect with you, that would be great.
Yes, absolutely. So I'm very active on LinkedIn. I put out daily content, mostly related to commercial real estate, sometimes related to travel and a lot of car stuff. But you can reach me there. First name Dan, last name Lewkowicz, Lewkowicz. Again, Lewkowicz. Reach out. Tell me, that you heard me on the Wealth Flow with Keith, and I'd love to connect. If you own property, if you want to know what it's worth, if you want to sell it, if you just want to talk about commercial real estate, or you're thinking about getting in, please reach out. I would love to help. My direct cell number is 248-943-2838. Again, 248-943-2838, and it'd be my pleasure to connect.
Awesome. Dan, this has been awesome, man. I've got two more questions for you that I ask every guest if you have just another minute. One would just be, any advice you'd give somebody who's just starting out in their investment journey?
Definitely find a mentor and make yourself dumb in front of them. That advice was given to me when I was younger. I should have taken it earlier. I made that person my mentor, but don't try to impress people. Learn as much as you can from others.
No, I love it. That's perfect advice. How about a book recommendation? It doesn't have to be real estate related, but it certainly can be. Just something you've read that's been impactful.
I'll give you two. The first one is called Influence, The Psychology of Persuasion by Robert Cialdini. Really good book. All these crazy sales secrets. I love it. I'd highly recommend it. And the second is a classic, Think and Grow Rich by Napoleon Hill. If you've read it, you haven't really read it, you got to read it a bunch of times. That book is incredible in terms of helping you understand how you can shift your mindset in order to shift your reality.
Awesome. All right. I have not heard the Influence one, so I'm definitely going to check that one out. Dan, I appreciate it, man. This has been great. Thank you so much for being on the Wealth Flow. Yep.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.